Yeah, wonderful. Good afternoon, ladies and gentlemen. Welcome to today's event on central bank digital currencies. What is their value added? We are very happy to organize this event jointly with the Atlantic Council from Washington and the Intereconomics Journal. I am particularly thankful to Josh Lipsky and Anaya Kumar from the Atlantic Council, and to Giffer Bourguignon and Ekaterina Sprenger, who are with us today, for helping us put the program together and organize the session. We have two sessions this afternoon where we'll be talking about, in the first session, very much the value added of CBDCs, why do we need them, and how should perhaps organize them. And then in the second session, we will hear from different countries, different jurisdictions, their current thinking. And of course, we were very careful to also select representatives from countries that actually have CBDCs that are operational, and therefore hear a little bit from their experience in implementing CBDCs and what they have learned, the challenges, their motivation, and how they can inform the rest of the world. But before we get to the two sessions, I wanted to spend a little time, and if we can have the presentation up, please, on just very factually the issue of what are central bank digital currencies, simply because I want to lay a ground on which we can build when we come into discussing their value added. I get a lot of questions in terms of what actually they are, so I will spend maybe a few minutes just taking you through the basics of central bank digital currencies, the way that we understand them. This is a snapshot of the central bank digital currencies tracker, the very wonderful work that the Atlantic Council has put together. And this is just to show that there are 114 countries now that are at some level of development of CBDCs. And the color will tell you what level they're at, what phase they're at in terms of the development and the thinking of the CBDCs. So there are many countries who are actually thinking about developing, testing, pilot phase, and possibly also launching it. There are 11 countries in the world that actually have CBDCs that are operational, and it would be interesting to understand what their motivation and what they've learned from it. So this map is actually telling us that CBDCs are happening, and I think this is an important thing to reflect on because we're still under the impression that CBDCs is something for the very distant future. But before I get there, I wanted to explain the way that I understand how CBDCs fit into the bigger picture in terms of money. This is a graph that my colleague, Gregory Claes, who will also be part of this event, has put together in the first time we wrote a paper about CBDCs. This is a little bit adapted, just to place it in the types of money that we have in societies like ours. There are two types of issuers, public and private. And in the private issuers of money, we have physical and digital. Physical could be any commodity that is exchanged for any transaction. It could be in the barter economy. And digital, we have two types. We have the cryptocurrencies, which are, of course, the bitcoins of this world, and back deposits, which are, of course, sovereign money, but they are issued by private banks. They're legal tender because they refer to the sovereign money. But what's important about this is that they're not guaranteed in full. Only part of your deposits are guaranteed by the authorities. On the public side, public money, we have, again, two, physical and digital. Physical, of course, is the coins and the banknotes. And digital, this is where the central bank digital money will come in, legal tender. But this time, the public money is guaranteed in full by the private institution, by the authorities, just like the coins and the banknotes are. And in fact, this brings me to the number one question that I get all the time: what is the difference between a digital euro and a euro that we use digitally every day? What is the difference between the two of them? And the difference is that a digital euro, or any CBDC, is fully guaranteed by the state, just like cash is, the notes are, whereas a euro that we use digitally every day is not guaranteed in full because the deposits are only partially guaranteed guaranteed. In the euro area, the amount of guarantees to the order of 100K. In the US is more than that, but effectively it's not that all deposits are guaranteed. And that will be, of course, a very big difference between the two as far as the consumer is concerned. But why did central banks get interested in central bank digital currencies? And there are multiple motivations. I try, Katerina and I, my co-author in these efforts, we've tried to bundle them in 4 different categories. We think they're encompassing. The first one is the fact that payments are becoming increasingly digitalized, and therefore the thinking is there is less of a demand for cash. Now, why do central banks worry about that? They worry because cash is often associated with the anchor to the system, is the money of last resort. If something happens, we all run to cash. If we don't have physical cash, do we still have an anchor? And the thinking of the central banks is, well, we provide a digital equivalent of the cash, and that would be enough for an anchor. At the same time, in the last 10 years or so, we had the emergence of cryptocurrencies. These are privately issued money, and there is a fear that, first of all, these private currencies are not necessarily stable, so there is an issue of the system stability on the financial side, but also the fear is if there is a greater use of this private money, then the monetary base, what central banks actually use to manage the economy, may actually be undermined. So they fear about also monetary stability. So in terms of motivation, financial stability and monetary stability may be under threat as the system becomes increasingly more digitalized. Now, there is a very big number of countries out there, particularly of countries where not many people have access to digital payments or to bank accounts. They're what we call financially excluded. By providing a national currency, they're actually given access to many of their citizens. So the motive of financial inclusion is a very big motive, and effectively, those countries that have actually started using the CBDC are typically countries who have got financial exclusion problems as a first-order problem. And then finally, it brings me to the last motivation, and that is similar across all jurisdictions, across all countries, and there is a way of thinking, central banks think, about increasing the effectiveness of payments and the efficiency of payments, and CBDCs are seen, particularly because they use very modern technology, as ways of increasing the efficiency of payments. So these are, strictly speaking, the big motivations, the 4 categories of motivations, but they're not the same for all countries. So some countries care more about one than the other, and of course that varies from country to country. No doubt we will hear about this in both sessions. Now, I remind you that just like physical cash, the digital cash will have a dual purpose. It will be used for retail, consumers like us, and small businesses to make payments, and it'll be for wholesale, bulk, to be used primarily by banks or financial institutions. This is an important thing because we will talk about which one is the most interesting one and why later on. And just to remind you how, if we were to have CBDCs, what would look different by comparison to what we have today. And I just have here a little schematic representation of the difference. The left graph is what we have today. The right graph is what we will have if we were to have a euro with designed for retail payments. A person that wants to make a payment today instructs their banks to pay the corresponding amount to the payee. So the blue person pays to the red person via their banks. The transfer is done by the banks, but it is settled by the central bank, and that is true for all currencies. If we were to have a retail CBDC, so a CBDC for retail purposes, we won't need the banks. We will have directly accounts at the central bank, and the central bank will issue the payment and settle the payment. So there is a difference in the way that we as consumers will experience the retail CBDC. There is a small footnote here because we will hear later on that actually banks will be involved in managing this, but in principle, consumers will have direct accounts at the central bank, something that does not exist today. By contrast, when you go to the wholesale CBDCs, there is very little difference. Wholesale means banks, makes the bulks, which is paid by banks, but banks already have accounts at at the central bank, but we call the reserves. Banks have accounts. So in fact, in terms of wholesale CBDCs, we already have wholesale CBDCs. What will be different is the technology behind it. And we will talk, I think, about the novelty of the two. Now, that's all I want to say in terms of what CBDCs are. And in the next two sessions, we're going to go through a number of questions, and that is, well, why do we need them? Will this change the way that the financial system operates? Can digital money be programmable? This is something that is of great concern here in Europe and elsewhere. Programmable means, can it really expire? If it's money on a digital account, can it expire? Is my privacy protected? Are digital payments anonymous? Is this really a solution to financial exclusion? Are CBDCs a geopolitical tool, and how? And of course, we are going to hear answers to these questions from the countries, from different jurisdictions, and we will learn from their experience. So, without further ado, I then want to go into the first session, and I would like to invite Jiffer to join me here, who will moderate the discussion.
Okay, test. Yeah, I am on. Okay, thank you, Maria, for the introduction. Welcome, everyone, to the first session of the two today. In today's first session, we're looking at having a little debate on CBDCs and their pros and cons. But before we get into that, I wanted to ask everyone to do me a favor. We're going to take a little poll. So those who are watching at home can go to slido.com. Those of you here in the room too, you can go to slido.com on your phones. And when you do that, you'll find up on top a little prompt asking for a hashtag, and there you're going to write CBDC. And when you do that, you're going to get to a question. And that question is, should the ECB issue a digital euro? So we would like to ask your opinion before we begin. And I mean, we obviously haven't had an opportunity to speak with all of you, so we don't know. I mean, maybe some of you know quite a bit about CBDCs already, and for some of you, this is a brand new topic. So we're going to get a little bit of a feel for how everyone is feeling about the CBDCs, and then we're going to check in with you again at the end of session one to see how you feel about it, maybe at the end. Oh, there's a little echo there. Good. So I would like to start by introducing myself. My name is Jiffer Bourguignon. I am an editor with Intereconomics, Review of European Economic Policy from the Leibniz Information Center for Economics. And I'm going to be moderating this first session. It's my pleasure to introduce Maria, who has actually already introduced herself. Maria is a senior fellow here at Bruegel. I'm going to take this off because I think it's banging into my microphone. And we also have with us, not in person, but on the screen, Josh Lipsky, who is joining us. Is he there? He's coming in.
Hi, good to see everyone.
There he is. Josh is the Senior Director for the Geoeconomic Center of the Atlantic Council in Washington, D.C., but today coming in from New York. So, first of all, thank you, Maria, for the excellent overview. And what Maria had presented to you all was a lot of information, and we're going to go a little bit deeper into that information and unpack some of the issues. Again, as the session said, it's about pros and cons. So we're going to take a look at some of the pros and the cons and how they could play out here in Europe, in the US. And in the second session, we're going to talk to practitioners, people who are already working with actual CBDCs and those who are in various stages of development. So we're going to discuss a little theory here, and we'll go into more practice in the second session. So, is what, yes. So, central bank digital currencies. Maria gave a brief introduction. They are increasingly gaining traction. According to the Atlantic Council's tracker that Maria also discussed, 114 countries around the world, representing nearly 95% of global GDP, are in some stage of developing CBDCs, and 11 countries already have them operating in parallel to their physical equivalent. But as digital transactions also become more popular, it is important for the consumer to understand the difference between a euro that is used digitally every day and a digital euro, which Maria presented, and it's, as you have now heard, not just a matter of semantics, which actually I thought may be the case at the beginning. So we're going to take a look at whether or not consumers really need a digital equivalent of their own sovereign currency, and if so, why? As the answer varies from country to country, we are going to explore, like I said, individual examples in the second session. But before we do that, we are going to take a look at the poll real quick and see, hopefully everyone has had a chance to answer. Let me pull it up here. Look here. Well, that is a pretty positive for the ECB's issuing of a digital euro. We have 64% who say yes and 36% who say no. So keep that in mind. Oh, just rose to 64% to 36%. So 64 of you who responded believe that the ECB should issue a digital euro. We're going to get into the discussion now, and we're going to revisit this question at the end of the session. Okay. So I would like to perhaps start by getting a little bit deeper into something that Maria pointed out in her presentation, the dual use of CBDCs, and specifically retail and wholesale. As Maria mentioned, retail involves consumers and small businesses, whereas wholesale applies to banks and financial institutions. Maria, could you maybe go a little bit deeper into the uses of each of these and where things stand in terms of their development and potential use of these two forms of CBDCs?
Yeah, sure. Thanks very much, Jennifer. And of course, I have obviously a euro bias here. I mean, because I'm thinking about the use of these new currencies in the context of the euro area. And of course, Josh has a bias for the US, and that's actually why we are here together. But I think before we do that, I think it's also important to reflect on those who are not represented in the panel, and those countries that actually have CBDCs and maybe have very different problems, very different financial systems than the ones that jurisdictions like mine and Josh's represent. And I'd like to start with that. I think the principle of the motive of financial exclusion is actually a very interesting motive. There's big parts of population across the world that do not have access either to digital payments or to bank services. Simply private financial institutions will not give access to these institutions, to these individuals, because they're risky individuals, which means that there's a big number of people that are excluded from something that could be welfare enhancing for them. And here the motive, and central banks in these particular jurisdictions have thought about designing a digital equivalent of their own sovereign currency without having to sort of scan the individuals and therefore give them access at least to digital payments. In particular, because the use of phones, of mobile devices, is very popular in many jurisdictions, and therefore that would be the opportunity to try and bring these people into the financial system. So we wrote a little paper on this, and we went around and looked at the experiences, and the motive, of course, is very important. On top of that, I should add that countries that have got typically weak currencies correlate with countries that have got social exclusion, digital exclusion, and financial exclusion problems, and therefore they're fertile ground for cryptocurrencies to thrive. So the cryptocurrencies are accessible, and they're easy to use. But of course, they are a source of financial instability. If you think about the Bitcoin, which is by far the most popular currency, is also the one where the price of is extremely volatile. So you will have people using currency that is actually extremely volatile, which has there will be ups, but there will also be downs. So in terms of wealth creation, they are not the best instrument. So central bank in these jurisdictions worry about financial stability problems in their own jurisdictions, and therefore the CBDC will be a good way of moving populations away from the use of the crypto into something which is equally digital but a lot more stable. In fact, some of the evidence in these countries is that people don't necessarily understand what is the difference between cryptocurrency and CBDC. That's why it's important to always have the little graph I put at the beginning on the types of money to simply understand what lies behind any digital form of payment. Now, okay, so all of this is in the context of what I call the retail CBDC. So a CBDC for retail purposes, right? It is the consumer that uses it. On top of that, of course, then you have banks who do payments. Banks do payments domestically between them, or with banks in other jurisdictions. And this becomes interesting, I think, in jurisdictions like ours, the Eurozone or the US, and that is the whole CBDC. So here, I think, in the Euro area, the retail CBDC has got much competition. By that I mean we do have lots of different other ways of making payments, and therefore it's not obvious what a retail CBDC would add more than we already have. Now, of course, I did say at the beginning that a CBDC, a retail CBDC, is fully backed by the authorities. So, from the consumer perspective, it would be quite interesting to have my deposits guaranteed. Now, that is not an easy thing to implement, and therefore that is why we see banks, central banks in jurisdictions like ours who want to limit the amount, which of course then makes it less interesting again. Where I think there is interest is on the wholesale, and particularly between banks in the Eurozone and banks outside the Eurozone, where we currently see that there is huge frictions and very high costs. If we were to have CBDCs on the wholesale side across the globe, we could potentially have an interesting value added for the consumer.
Josh, how does it look from a US perspective? I mean, Maria already mentioned the more European side, and we're going to have a number of representatives talking about how it looks there. Maybe you could fill us in on the US perspective.
Happy to do that, and thanks for having us, me and my colleagues from the Atlantic Council today, and wonderful to be here, Jiffer and Maria. So look forward to the conversation, and I agree with many of the things Maria said, and a few points of disagreement, which I think will make for lively discussion during the session. From the US side, I think there is a major split between retail and wholesale right now. So if we look at the retail side, publicly, a lot of the conversation has stopped because the issue has become very political. In the US, there was some work going on. I think that work continues, but in a much more quiet phase inside the Federal Reserve. And we can talk about why that is and the work that's already happened on the retail side. But even while the US has its domestic retail debate, the Fed and Treasury and the other agencies, as well as the Hill, are very interested in global developments. And so the US is at this point where it may not be developing a retail CBDC as fast as the Eurozone and the ECB are, but it's very interested and wants to help influence the other CBDCs around the world in the jurisdictions that are further ahead, because it's concerned about privacy, it's concerned about interoperability, it's concerned about cybersecurity. And the question is, how do you influence those developments if you don't have a model yourself to bring to the table? And that's some of the debate on the retail side that's currently happening in the US. The wholesale side is very different. There's a lot of work on the wholesale side, and the most notable project is from the New York Federal Reserve, and that's called Project Cedar. And that's a wholesale CBDC project between New York Fed and Monetary Authority of Singapore. It's just gone into what we would describe as advanced development. They're actually testing values. They're showing atomic settlement, meaning near instant settlement at a large scale, and they've shown significant success. And if you want to understand why the US is so interested in wholesale, and Maria brought up some of these issues, one key driver for the US is geopolitics and geoeconomics. It's not a coincidence that in the wake of Russia's invasion of Ukraine and the G7 sanctions response on Russia, wholesale developments around the world have nearly doubled, according to our estimation at the Atlantic Council. That's because a lot of countries are interested in bank-to-bank transfers cross-border outside the current corresponding banking network, outside of using SWIFT and other messaging channels. And wholesale CBDCs offer that opportunity. The US sees that, and therefore the US wants to be very involved in whatever this next generation of cross-border payments looks like, and it could be wholesale CBDC. So that's a little bit of where things stand between wholesale and retail in the US right now.
Maria, go ahead.
May I add to that? So I think we are in the interesting paradoxical position right now where the ECB has actually put a lot of effort in understanding complex trade-offs, in understanding the technology behind it and how to do it. But it only really talks about a retail CBDC. And I think the case for building a retail CBDC is much smaller than it is for thinking about wholesale CBDC for exactly the reasons that the US is involved. Now, it is also true that all these things play into the international role of the dollar. And if you like, a development of the wholesale CBDC means that the dollar has a lot to lose, the most to lose. But I think the euro area also has quite a bit to lose. And I think understanding how the development of wholesale CBDC is going to affect our economic standing is absolutely essential. So the paradox here is that the ECB that has put a lot more effort in understanding is put a lot of effort in understanding, if you like, the wrong thing, which is the retail CBDC. I think a lot more effort needs to go into the wholesale CBDC, and actually would be very welcome if even the European Central Bank went into some testing phase, which we are still far from.
Could I just make one point on that? I would just say that from a US perspective, I think there is a lot of welcome for what the ECB has done on the retail side, because it is the largest central bank, Western central bank in the world, that is developing a retail CBDC. And the issues they are grappling with, and we'll see the answers they come up with in a few short months on offline payments, on interoperability, on cybersecurity, could be standard setters for the rest of the world in a very positive way, from my perspective, for the Europeans, in a way they've set standards in other areas. And I think that that could actually be a huge value add to the rest of the world if they're able to develop these solutions and help come up with answers for other countries that are further along in CBDC development on the retail side.
Okay, and how would it look then? You touched on the issue of privacy and anonymity, and as far as I understand, privacy would be possible, but anonymity questionable. That maybe causes concern with potential users. So how would that be addressed?
Sure. So it's a very important question, and it's important to distinguish privacy versus anonymity. And we always say replicating cash in digital form, but there is a level of anonymity that comes with cash that will be near impossible to fully replicate in digital form. And the question is, what does that balance look like? And so one way that central banks deal with this is through a tiering system, meaning that if you hold a low dollar, low euro amount, under 50 euros, under 100 euros, there's far less information required to hold that CBDC. That's what we see with CBDCs around the world. You might only need a name, potentially a phone number, so low information required to hold the CBDC. And once you get to higher value amounts, 5,000, 6,000, 7,000 more, it becomes more what we would consider typical account information from a banking institution. But something that's very important that gets misunderstood in the CBDC debate is, while it's conceptually and technically possible to have a CBDC that is disintermediated, meaning I look at my phone and I have an ECB app or a Fed app, that does not happen anywhere around the world. So every CBDC we study is intermediated through the banking system, meaning the banks are the ones delivering the CBDCs. They are the ones managing the accounts. They are the ones managing the AML KYC. And I think it's just a very important nuance to understand that from a consumer perspective, it may not feel that different than the way you interact with your bank right now. It would be different, as Maria said, in terms of the liability. So the answer to the question is, there's not full anonymity, but there can be much more anonymity than you currently have in other systems. And depending on the value amount you have, you can have very little information required to transact that CBDC.
If I may add to that, so there's very often the concepts of privacy and anonymity are kind of bundled together as though they're the same thing, but they're not. And so privacy, I think, certainly from the point of view of the euro system, is guaranteed. The technology, but also the governance of currency will be guaranteed. This is something that is very dear to the European consumer, and that I have no doubt in believing that it will be fully guaranteed. However, anonymity is something completely different. And actually here, the ECB and other central banks do not want for these payments to be anonymous, precisely because they worry about money laundering and the likes. So it won't be anonymous. And that, of course, brings us to the question of how close to cash is the digital equivalent, given that it is not anonymous. The one feature that cash has is that it's anonymous. But then again, I'll say that even cash really isn't all that anonymous, given that there is regulations that we have in many jurisdictions that you can't really pay by cash for big amounts. So really, the if you like, the insistence on anonymity is something that is a little bit elusive, because even in current systems, we don't have full anonymity. However, it is true that when I do have cash in my hands and I pay, then it is truly anonymous. I mean, you do not know what it is that I have paid, and cannot be reverted back to me. And it's interesting to see this in jurisdictions where they tried to get rid of cash. I'm thinking here of Sweden. They actually had to revert back, because there will always be a demand for cash for that anonymity. And in fact, I wanted also to tell you a little bit about the numbers, because we keep thinking that our societies are becoming increasingly digitalized. And I remind you that one of the motives for thinking about CBDC is the fact that cash will disappear anytime soon. Well, 42% of all payments done in the euro area were done by cash in 2022. 42% is a number which is telling us that cash is not really going away. This has got two things. The anchor is there, and the fear of the anchor. But on the other hand, so the anonymity thing is still very dear to the way that we make payments. So if you were to make equivalent payments with a digital currency, you would have even the slightest anonymity. As Joe said, the phone number or the name, it wouldn't be truly anonymous. The question is, do we care? I mean, this is really the issue here. Personally, I don't particularly care. I mean, you're in jurisdictions where these things don't really matter. The governance is good. But it's important to understand that it's not a fully substitute for cash. It's a near substitute for cash.
Cash is also something that, perhaps counterintuitively, as one might think that there has been more of an increase in the use of digital transactions, especially given the pandemic. The actual demand has increased counterintuitively. I know that the Germans have an expression that goes, nur Bares ist Wahres, which translates as only cash is real or true. There's a certain affinity for cash, and sometimes in the public a mistrust for other forms of currency. So how would central banks increase the acceptability of digital currencies among the public?
Well, one thing I would say is that it's very important to understand CBDCs are a complementary tool to the existing payments that exist, including paper cash. Now, maybe that changes over a long period of time, 30, 40 years, but in the near term, paper cash and CBDCs, by almost every central bank's estimation, coexist. The ECB has said this as well. And it coexists with current payment systems, the way you use your credit cards, as well as potentially well-regulated stablecoins. So it's important to think of a digital asset ecosystem where CBDCs are a component, not a replacement for other things that exist out there. I think the ECB and the Eurozone more broadly has a huge advantage in this area, because to introduce a CBDC, you have to communicate to citizens the value add of a CBDC, the purpose of our discussion today, why it's different than what they currently have, and the use cases for it. The Eurozone has a recent history in 20 years of talking about a new currency, talking about the euro, and explaining to citizens what this is different from their current system. That's actually a very difficult concept for something like the Federal Reserve or the Bank of England that has no muscle memory of what it's like to introduce a new form of fiat. So if any central bank can do it, I actually think the ECB could do it, but it requires a lot of communication with the public over years. And it's very important when we talk about issuing a digital euro, this is still years away, even from the ECB's planning. What they are talking about now is a technological model, which will be introduced in the fall, and then starting with a pilot project potentially in 2024 in a few select cities. So I think it's just very important to say that we don't have all the answers now. Part of the purpose is experimentation, and it doesn't mean that we will not learn things in that process, some good, some bad, about what's working, what isn't, as we go through the years. So it's a development process that we're in that will take years to revolve and then basically get to the issuance phase.
If I may add to that, so what's interesting, that what Josh said, that if there's any central bank that can sort of deal with kind of a new concept, that is the ECB. On the other hand, I will say when it comes to cash, there's huge heterogeneity in the whole of Europe. And here I am talking beyond the euro area. You have countries that have got a great affinity with cash, Germany being one of them, but you have other countries that are extremely digitalized, Sweden being one of them, but other countries, you know, the Baltics, Finland, there is much less of a demand for actual cash. And that feeds into this idea of what I said in my original presentation about cash being the trust, the anchor for the system. And this is, you know, when something goes wrong, we all we run to cash. It's the payment of last resort, as it were. And you know, as we become increasingly digitalized and we do everything digitally, do we really need cash? Will cash still remain the anchor of the system, or will that be replaced? So I think and you know, since Josh said that this is something this is for the future, really I do see the CBDC as also an attempt to prepare for the future. Maybe for the moment it's not something relevant, but you know, if you were to go, so think about 10 years, 20 years, and the ECB very much motivates it that way, that actually we need to be future prepared, as it were. So we need to put everything, understand the difficulties of this, just in case we had to go in a system which is fully digitalized. We need to be clear on whether we have an answer to the question, is a digital cash as good an anchor as physical cash at the time when physical cash is eliminated? And this is a thing now what we're trying to learn. But I mean, on the argument that the ECB is the one that can do it, I think we need to also take into consideration the huge heterogeneities in preferences, if nothing else, amongst the stakeholders of the ECB, which is of course the different countries.
So looking into the future, as you said, it will take time, and it's still in development stages. The ECB is putting out progress papers and is expected to have a decision in later this year. But looking at geopolitics as well, as Josh had mentioned, jurisdictions like the euro area and the US would have to consider carefully how this affects their economic standing globally. So I'm interested in hearing from both of you, what do you think they have to lose or to gain, and also how could global governance, it's a overwhelming prospect of the idea of putting something like this together, I think. How could global governance hinder the design and use of CBDCs?
Well, this is such a big question, Differ. So maybe I'll start with the U.S. side. My opinion is that the U.S. has been too cautious in this area. Something you hear a lot from Chair Powell is, you know, we're the issuer of the world's reserve currency as the dollar. We don't want to do anything to destabilize that and don't want to make any mistakes. And so it's better to be, you know, that we don't want to be first. We just want to make sure we get it right, which of course is a perfectly understandable perspective, but things are moving very quickly around the world, as we see from our tracker and the map that Maria showed in the beginning. And there is a risk of being left behind from a US perspective. We already see, because of geopolitics, interest in shifting away from the dollar, interest in using more sanctions evasion tools, interest in getting away from the way SWIFT is used to enforce sanctions, interest in the way reserves are being a different composition around the world, difference in invoicing for petrol and other things. And so if the US doesn't lead in this area, doesn't innovate, countries will find new tools, new technological systems, and over time, I actually believe that can erode dollar influence around the world. And it's not a short-term problem, but it is a medium and long-term problem. So the US needs to be a little more forward-leaning. And again, I do give the ECB credit for this, because it is about future preparedness. It is not about the world as it stands today. Do we need a CBDC? Do we not? You can make a case we don't need it at this moment, but you can also make a very good case in 5 or 10 years. We may regret that we did not invest the time and the money and the resources to be prepared for that situation. So for all those reasons, from a US perspective, I think there's much more can be done, and it can impact the role of the dollar in the world. I talk to a lot of central banks when we do our work. One thing they say to me privately and publicly as well, I wish the US was doing more in this space. And I think the US, as the issuer of the world's reserve currency, needs to listen to that demand signal. If countries around the world are saying, where is the US? Why are you not at the table when it comes to the cybersecurity questions, when it comes to the privacy questions, when it comes to the tiering and cap questions? I think that's a lack of leadership from the US perspective as the issuer of the dollar. Whether we do one domestically or not, we have to be much more involved in this conversation. So my answer is that from a geopolitics, geoeconomics perspective, much more can be done from the US side.
So just to add to this, and so Josh and I are currently thinking very much about this geopolitics thing and how the EU and the US jurisdictions that are kind of similar should be thinking about the global standing as CBDCs evolved. Let me add a couple of things to this discussion. The first one is that I was... or perhaps the other way around. The dollar, the reason why the dollar is a currency that is the global currency is because it is a strong currency, so we all want to price in dollars, but we also use the dollar settlement system when we trade. So most of the financial flows for trade purposes, for any other purposes, go via the dollar, which means that, if it's a country, let's say India trades with Chile, in no likelihood all of this will be invoiced in dollars, which means that it is the US authorities, the clearing authorities, that actually settle this transaction. So we want the dollar because it's a good currency and because it provides us with the infrastructure to do the settlement. And the settlement is a very important part of this transaction. The US has got the legal framework that allows for this to be trustworthy, and that's why we use it. If we move fast forward and we have CBDCs that work bilaterally between any two countries, then the second role of the dollar is eliminated. We don't need the dollar infrastructure to actually do the settlement. Maybe we still need the dollar because it's a good currency, so we like to price in dollars. But we won't need the second part. And that, of course, raises the threshold of actually using the dollar, and this is where the dollar may be actually losing some of its oomph, as it were. To a lesser extent, this is also relevant for the euro, because the second currency of choice, by far, by great distance, that is the euro, and that is interesting. Now, the reason why it's geopolitical, last year, when obviously the invasion in Ukraine started, the Russian invasion, we had this very interesting thing where Putin asked the Europeans to actually pay in rubles. This was a very strange request. Why did we have to pay in rubles, and when actually the euro is a much better currency? And the reason for that is because of the settlement had to go via the European settlement system. At the time it was called Target 2, now it's called T2. Because of the sanctions, Putin didn't have access to the euros. So it is an instrument for blocking your adversaries, and this is exactly what happened. What happened at the time, and we being Europeans, we were forced to buy rubles and settle the contracts, clear the contracts in rubles. Otherwise, we wouldn't have been paying the provider of gas at the time. This was here comes the settlement system as a very geopolitical tool, used the wrong way being the other side in this particular case. But imagine now a system in the future where we have central bank digital currencies talking to each other. Trade and financial flows could be settled in any bilateral system that de-emphasizes the role of the dollar, the role of the euro, the role of what we call the Western currencies that are popular in this respect, and allows countries to settle bilaterally. I remind you, 3 weeks ago, President Lula of Brazil was in China and, of course, told the Chinese, why do we still pay in dollars when we trade with each other? Basically, they're thinking about this idea that we need to find different infrastructures that is going to allow us to effectively bypass the dollar. So I think Josh is right that from the US perspective, the dollar has a lot to lose. Now, from a global perspective, this may be an improvement. I don't know, it remains to be seen, in the sense that, if you like, democratize maybe is not the right word, but at least, you have allowed countries to deal economically in whichever way the thing is appropriate and bypassing the dollar. It's not for tomorrow because, and that comes to also to your question about governance, for all of this to happen, we need to have a global standard. We need to have a legal certainty that the settlement that currently relies on the US law when you settle via the dollar is as effective as the US law. And this is not something that can happen overnight. So I also hear the people in the US who say, this is a dream. It's not a dream, but it's certainly something for the future. And a lot has to happen before that kind of scenario becomes reality. But for me, that's the direction of travel. And I think Josh is right when he says that we need to be active in this. And here I also agree that the euro is in a much better position. The ECB is in a much better position to come into this discussion. It's just that I would like for the ECB to think a little bit about the wholesale and much more the global aspects of what this means, not just the retail. I think the real value added comes on the wholesale, and also the real risks come on the wholesale in terms of losing your current standing.
Jiffer, can I just make one point on the democratization point? Because one, Maria's right, democratization is one way to look at it, but another way to think about it is splintering of the international financial system that raises cost on everyone if we have these, multipolar systems, regional banking networks that are transferring currencies between banks. And it's amazing to me, we went 30 minutes without raising China. So thank you, Maria, for raising China. That almost never happens in a CBDC conversation. But it is not just conceptual when it comes to China. Their retail project, which we'll talk about in the second session, my colleague Ananya Kumar will talk about, but also their wholesale project, Project Enbridge, which is a cross-border wholesale project between the People's Bank of China, Hong Kong, Thailand, and the UAE. And it just settled a few months ago, $22 million cross-border. This was the first live real money transaction cross-border on wholesale CBDC ever transacted. So we are behind from a Western perspective on the wholesale side. That is simply the case. And if there's not more international standard setting, to your point, Jiffer, then there will be, I really think, a risk of splintering and regionalization of these banking networks that I don't think will be in the US interest, but I also don't think will be in customers' interests globally.
I think the interesting thing is, the average consumer in any country in the world, is that person or company or bank better off having one system or dual system or multiple system? That, of course, is an economic concept. We can discuss that. But what is true is that it will change. So the current system will change as a result of having an alternative competitive system. Whether it's better or worse, there's network effects, there's consumer costs, there's monopoly power can be exercised. So all of this will be great subject for great research for Bruegel.
And I'm sure it will be in the future. I would like to take a few minutes to take a few questions. We have, I think, someone with a microphone. Yes, the gentleman here, I think we have a microphone coming to you. If you wouldn't mind stating your name, and then the floor is yours.
Marek Dąbrowski, Bruegel. I have the factual question, I think, to Joshua. You mentioned that there is flight from dollar as international currency and from SWIFT system. I'm wondering, do we have any hard data behind such statement? Or these are only declaration of politicians or warning of politicians of some speculation? Maria mentioned the statement of President Lula. I do remember that I think 2009 or 10, Central Bank of Russia and People's Bank of China, they declared that we should move from dollar to SDR. And nothing happened after this. So perhaps we are in similar situation now, that there are some speculation, but not necessarily change in reality.
Okay.
That's an excellent question. And we at the Atlantic Council often say it's important to distinguish rhetoric versus reality when it comes to de-dollarization talk. And I think that's the point you're getting at. It's one thing for President Lula to issue the statement, but then we have to see in reality what actually changes in terms of invoicing, in terms of currency reserves. I think what is true are a few things. One, the demand signal from countries is very strong. We hear this publicly and privately, to find alternatives to the dollar-based system. And that has accelerated since the way sanctions have been imposed by the G7 on Russia, because countries around the world, especially in the global south, have seen that and have thought to themselves, and you can see this in the way India talks about the SWIFT system as an example, I cannot be overly reliant on one system for my currency transactions. And I'll give you just one anecdotal example that happened recently. Bangladesh did a transaction paying for a nuclear reactor that Russia provided through Chinese SIP system, through their messaging system. And we believe, although it's hard to get this data in real time, but I think over the next year it will show it more clearly, there has actually been a significant increase in use of the SIP system for cross-border transactions. Now, SIPs relies on SWIFT in some instances, in fact, in most instances, but not in all instances. So I think there's anecdotal evidence that there's a move away from the dollar-based financial systems. But to Maria's point, does that mean there's a move away from the dollar itself? And there, the question is more complicated. If you look at dollar's share of currency reserves, yes, it has decreased over the past 20 years, as we all know, but very slowly, and still far outpaces any other currency, including the euro. So it's not so much to me the dollar as the currency reserve, the dollar is the global reserve currency that seems at risk, but it's the financial plumbing, which I see being slowly eaten away at through technology. And I think there's where you see more data in real time developing, that there is some erosion.
So if I may add to that, to Kumarek's question. So the first thing I will say is that the example that Josh used on the Bangladesh, this was a transaction that needed to go to Russia. So Bangladesh paid Russia using the Chinese system. So Bangladesh wouldn't have access to SWIFT if it wanted to carry out the transaction because it was with a country that is under sanctions. So if Bangladesh wants to continue, have full degrees of freedom and continue to have economic relations with Russia, they need to find an alternative system of doing that because the current system, the SWIFT system, or indeed the settlement wouldn't have allowed them to do it in any other way. So, this is a way for Bangladesh to ensure business continuity. That is not allowed because of sanction system that countries like the US and the Euro and the EU have imposed. The second thing I will say on the de-dollarization. Well, it's true that the shares have remained the same of global currencies. First is the US about 60%, then is Euro about 20%. One thing we've observed in the last year is a 10% reduction of all Western currencies used except the Swiss franc, and a 10% increase in dollar reserves. So this is where it comes the geopolitics come in, where countries have moved away from dollar, from euros, from British pounds, and they moved into something else, which is typically the something else of last resort, that's gold. So this is a very striking increase in in gold reserves in just 1 year, which is of course points to the weaponization of finance argument. So again, I do not believe that the dollar is going to lose its position anytime soon, and by comparison to other currency, it will still be the dominant currency for many years to come. But there is a direction of travel, and I think this is important to appreciate, that there is at the very least a splintering, as Josh mentioned, that actually is worth pointing out.
Okay. I'm going to take a couple of questions from our audience at home or wherever. And just so you know, you can ask questions online again via slido.com. And I'm going to put 2 of them out there so we can take a look at both of them. One is a more technical question, perhaps. How are digital euro and digital dollars really connected? And one more, which might be something that more people are wondering. Another question comes from Emily. People bartered with other things before money. They will learn to replace cash with digital money. But what about unequal access to the internet and literacy? And that goes back to our question of inclusion. Maria, would you like to start with one of those?
I think Josh should take the first one, and the second one on literacy. Yes, absolutely. I mean, and again, in the second session, we'll hear from countries that actually have it, and it will be interesting to hear their experience. But from our own reading, when Katerina and I looked at the numbers, we actually found that the digital access and digital penetration in some of the countries that have CBDCs is not what it could be. People have phones, but they don't have digital access. If you don't have digital access, then you cannot really use a digital CBDC. So, and on top of that, then there is the literacy, digital literacy as well as financial literacy. A very interesting argument I heard the other day was that we need cash because it's the only way to learn about finance if we sort of see our cash disappearing. Because if it's digital, we don't learn about the value of money as fast as otherwise, which I think has some interesting points. It's not the end of the argument, I think, but it is important to reflect on the fact that we need literacy on both digital and finance to understand what a CBDC can do for us. But I think that the evidence so far, and Katerina may correct me here, is that the CBDC hasn't really been the best answer to financial exclusion because of the lack of infrastructure. So while I think it is a noble cause to try and to implement a CBDC at the country level, to try and bring people into the financial system, without the digital infrastructure, it may be not a very successful thing. And we actually see that the uptake of the CBDCs in those countries isn't as big as perhaps what we have hoped for. So I think it's a very important question and one that we need to sort of make sure that when we implement a CBDC, we also implement the conditions that you need for a CBDC to thrive. I'll leave Josh answer the first question.
Yeah, no, happy to answer the first one. And on the second one, I just would say that sometimes I think the term financial inclusion might be the wrong term to think about with CBDC, because I agree with Maria that for a lot of reasons we see use cases here, and CBDCs don't necessarily answer the financial inclusion issue. They just, if you don't have access to a phone, there are options. There's cards they do in China. So there are ways to get access. Offline payments is critical, but it just may not be the solution to the financial inclusion unbanked problem. But financial security is different. If payments can come quicker, if you don't have to wait for a paycheck every 2 weeks, if you can have instant payments from the government over the weekend, there's a way to think about those who are banked or underbanked and their relationship to finance that can be really made much more secure, not waiting for payments and the stress and anxiety and financial hardship that causes. And there is a way through technology to improve that, even for those who are currently in the financial system. And that's why I like to talk about financial security, not just financial inclusion. On the digital euro and digital dollar, it's a good question. We don't know because they don't exist, but the interoperability question is key. One thing we see on this point is that the commercial banks that are first to market that are able to create interoperability through their distribution are the ones that I think are going to win this race for the future of money. Meaning what I think consumers want in the future is to open up your phone, have your commercial banking money, have your digital euros, be able to travel to the United States and exchange those instantly and seamlessly for digital dollars. You also want to be able to transition in that same app to stable coins. So this sort of one-stop shopping idea that can be housed is where the future is going. And those that are able to provide that, I think, will be ahead of the game. But we're just not there yet because we don't know what a digital euro looks like technologically. We don't even have a digital dollar pilot anytime in the near future. But the transition between them is going to be hugely important. And I think what's going to happen is that there are going to be different systems built, different ledgers, different technology, and there's going to be some hub of exchange. I've called for, and my colleague Ananya, a new SWIFT, a SWIFT that does settlement to do this kind of work. But whatever it is, there's going to have to be something that exchanges CBDCs cross-border, but we haven't got to that point yet because we're still in the development phase domestically.
Okay. Do we have any more questions here in the room? Okay, and before you ask that question, I'm going to give you the opportunity in just a second. As we are coming near to the end of this session, I would like everyone to go back to slido.com and answer the poll question there, which, as you will see, is the same as the one that was asked before. Take a minute to do that, and we'll take a look at the end of the session. Could we get a microphone for the gentleman here in the front, please? Thank you. Right here in the middle? Yep.
Thank you. Hi, so my name is Wouter Lames. I work for Deloitte. And my question is, one of the arguments that we've heard a lot, especially here in Europe, is a debate about Eurozone integration and how the possible digital euro would have possibly positive effects for cross-border payments within the Eurozone. What do you think of that argument? Because, of course, currently we already have some cross-border payment solutions. Will it improve or not?
Take that question. So thank you for that question. It's very important. And in the second session, we'll hear also where we think the thinking on the euro area. I would like to answer by starting by saying, in economics, we think about externalities. And what is the market failure here that the CBDC, the involvement of the state, the taxpayer, is justified by the involved taxpayer? If there are private solutions, why do we need a public solution? What is really the externality here of the market failure, right? And I think in the Eurozone, and we hear this from the ECB all the time, is that we don't have one payment system that is broadly acceptable across all countries. And that may be true, and it's worth resolving, but you have to ask the question, is a public solution the best solution to that? Why should does it justify the involvement of the taxpayer? Why should I, as a taxpayer, pay for something for the development of that system when we have so many private alternatives? Why can't we issue a law that coordinates these different payments and say that from now on you guys need to talk to each other so we have one system in the Eurozone? Why can't a regulation like this do it? So I think it's important to go back and answer exactly that question. Is there an externality that the public interference solves? Also, what would that do for competition? The other thing that we hear a lot in the euro area is this issue of strategic autonomy. It's an interesting number, and again we will hear it about that the ECB tells us about 70% of all card payments in the euro area are being intermediated by foreign companies. And then it asks the question, do we want that? Yeah, but remember the European Union is also a jurisdiction that believes in competition and believes in openness. So if we want to bypass that, we should create our own systems, but only in the context of a competitive environment, not through subsidies that actually are detrimental to the consumer and actually much worse for everybody. So that argument for me, noble though it is not necessarily one that can be solved by CBDCs only. If it is a problem, and I think it is a problem, it should be solved, but it should be solved in the most efficient way that it is. Basically means not the consumer has to pay for it, because for the moment, it is the taxpayer that has to pay for the development of CBDC, and the question is why.
Can I just say one thing? Because this is such an important point, and I agree with Maria that CBDC should not be the only solution, but I also believe strongly they should be a solution. Money is a public good. There are few things more important to sovereignty than the issuing of the fiat. It helps define nations. It helps define currency unions in the case of the euro area and the eurozone. And for central banks to remove themselves from that process and say only private solutions will be answer to this, I think removes an important role they play as standard setters, as regulators, as creating the baseline for healthy productivity in these new innovations. So it should not be the only solution. I really believe it should be a solution. And I'll give you an example from the US perspective. We have, some people say in the US, a private solution to a digital dollar. That is dollar-backed stablecoins, which we haven't talked a lot. 99% of all stablecoins that exist in the world are pegged to the dollar. So we all often talk about different pegs, but almost all of them are essentially dollar-backed stablecoins, USDC being one of the largest. When we talk to central banks around the world, they have concerns about what they call digital dollarization, right? So dollarization of economies is a long-known international economics concept, but digital dollarization through a stable coin is something that concerns central banks and economies all over the world. And what they ask in that scenario is, where is the Fed? Where is a US CBDC that is a backbone to the system? And that's how I think about CBDC, not as the only option, but as a backbone to the system that gives, from the dollar's perspective, confidence around the world in a public option, but not only a public option.
Okay, Josh, Maria, thank you very much. I'm afraid we're going to have to take a break here and prepare for a second session, and I hope everyone will stick around for that at home. We're also going to show you the results of the second poll. After everything that you have heard, should the ECB issue a digital euro? And the answer, well, a little bit less, 58%. If you remember when we asked the first time, 64% said yes. So perhaps a few of you have become a little more skeptical since you have heard what has been said here today. Well, we hope you stick around. And okay. I think a few more people are voting. Well, I don't know how long we can keep this going, but maybe we can check back in the second session and see what the final result. 61 to 39. It's moving. Okay. Yes,
well,
yes.
It seems to be there's an equilibrium. We have far less people participating now, but it seems there is an equilibrium, 60%, more or less 60%, that seem to believe that we should be issuing a digital euro. And I think perhaps an interesting question is, if a digital euro existed, would you open an account of a digital euro?
I think that's a great question.
Yeah.
Can we ask that one? Maybe next session. Anyway, thank you very much. We have to take a quick break. Thank you to Josh and Maria.
Thank you. Thank you, Josh.
Intereconomics will have all of the participants of session 1 and session 2 contributing articles for our forum. That will be also on CBDCs, and that will come out later in July. You can find that at intereconomics.eu. Thank you very much for being here, and we'll see you back here at 3:30.
should we start? Please take your seats. Those who are still in the next room. Let's wait one more minute. I see that we already have 3 of our speakers that are online. There should be 4, no? Ah, here is the final one. Okay, perfect. Everybody entered the room? Okay, so let's start then. So good afternoon, and welcome to this second session of our workshop on CBDCs. This session will look into more details on countries' experience with CBDCs. So my name is Gregory Kless. I'm a senior fellow at Bruegel, and I'll be moderating the discussion today. So I'm delighted to have with me 5 great speakers to discuss this important topic, who will bring different perspective and very complementary perspective because they come from different parts of the world. And so with me, or at least online today, we have Ananya Kumar, who is Associate Director of the Digital Currencies Geoeconomic Center at the Atlantic Council. She's online. Hello. We also have Jennifer Lassiter, who is Executive Director of the Digital Dollar Project, who is also online with us. Hello. You will tell us more, actually, what the digital project is. We also have Kwame Opong, who is the Head of FinTech and Innovation at the Central Bank of Ghana. Welcome. We also have Alan Wright, who is the manager of the research department of the Central Bank of the Bahamas. Welcome. And finally, last but not least, we have our own Katharina Martins, who is research analyst at Bruegel, and who has co-authored a paper that was just published recently by her and Maria, that was already highly discussed in our first session, but I still encourage you to read it either on our website or for those who are present in Brussels, it's available outside of the room. You can take a copy before you leave. So let me first thank all of you very much for accepting to participate in our event. We are really glad to have you either here or online. So the idea of this session, as I was saying at the beginning, is really to discuss why some countries may or may not need central bank digital currencies, and what are the different views and the different experiences of countries so far. So, but before I give the floor to our speakers, let me just tell you quickly how we will proceed. So we'll have short, let's say 5 minutes, please be short, introductory remarks, which will be followed by a discussion, in which we'll also take questions both from the floor in Brussels, as well as online. For those who are in Brussels, you will use the normal mics, while those online, you will be able to ask questions during the events through Slido, or directly actually on Bruegel's webpage, where there is a Slido thing on the webpage of the event. And you will need to use the code hashtag CBDC. So it's the same as for the first session. So let's start. Let me give the floor to the speakers. And let me start actually with the practitioners. So the people who come from countries that are quite advanced or even who have sometimes launched already CBDCs. So let me start first with Kwame. And then we will have, I will give the floor to Alan before we continue with the other speakers. So Kwame, maybe what you can tell me is, what is the motivation for issuing CBDC for Ghana? How do you plan to implement that? And if you have already done some demos, what are the main lessons that you have learned so far? So
thank you very much. Thank you very much, and good afternoon to everyone, both in the audience in person and online. So Ghana has been going through a rapid digitization process. As at sometime 5 years ago, we were the fastest growing mobile money market as a result of a plethora of policy interventions and increased investment in our digital financial services sector. But as we continue to digitize, we also began to realize that the role of the central bank is increasingly changing. And particularly, even if you look outside central bank digital currency conversation, the fact that we have private currencies or stable coins and cryptocurrencies being taken up by segments of the population, particularly now that we have a digital youth that increasingly is becoming the sizable part of our population segment, it became clear that we needed to start rethinking and begin to think what we can do as a central bank, on one hand, to be relevant to the future digital economy, and secondly, to also be able to perhaps provide consumers with a public option of the alternative of a digital version of currency. The reason why people have interest in there without any state institution mandating them to use it or providing it to them is that it serves a certain purpose, not just from a user experience standpoint and convenience, etc. It actually may have some attributes that are appealing to consumers. So we needed to think about that. And also the fact that the form factor of money that we provide today is physical and will be the source of inefficiencies and costs in the future digital economy. And so Bank of Ghana embarked on a CBDC pilot. So ours is called the ECD project. Our local currency is the city. And through the pilot, our primary goal was to understand, can this actually work in Ghana as a market? And so we're very focused in understanding the technology, understanding the concepts, and seeing how it fits in our local context. Of course, our objectives for pursuing it also included the fact that we saw an opportunity in financial inclusion. We saw an opportunity in improving monetary policy transmission and strengthening of the payment system. And so we conducted a pilot that consisted of two aspects. One of it was online, the other part of offline. The reason why we did both is that if we issue currency, the physical notes and coins today, it's available for people who are both in connected areas as well as offline. So if you're going to provide a digital version of the currency, you need to provide both. And our understanding of CBDC and our continued resolute commitment to it is based on the fact that CBDC is a dematerialized version of the notes and coins. It does not come to replace cash, at least not in the short term, as Josh mentioned, but it's an alternative and it's an option available to other consumers. But by the end of the pilot, which we conducted, and also I should mention, included two key things that were distinct in the Ghana pilot. There was the use of private sector players in partnering with us. So the central bank was very clear to stick to our mandate of being issuer of currency and staying at a governance and regulatory level, and partnered with banks, fintechs, and mobile money players for them to create the product and services for consumers. It was interoperable and it was also built to the highest security standards. And finally, we also included a consumer understanding study, which consisted of a baseline survey, a focus group discussion, and an endline survey for us to clearly understand what the variables to adoption would be and whether there were changes along the way. And then we had an independent financial inclusion study. All this because we believe fundamentally that an inclusively designed CBDC that puts the customer at the center is likely to see adoption and therefore help us meet our objectives. So that's what Ghana did. We learned quite a bit of lessons. And in the end of the pilots, the feedback we got was significantly in favor of introducing CBDC. Thank you.
Thanks very much. We'll come back to some of those points later, but let me give now the floor to Alan from the Central Bank of the Bahamas. And Alan, you can tell us more about what has been done in the Bahamas and how you implemented it, because If I'm right, you are one of the first country who introduced the CBDC.
Yes, you are right. We are actually the first country that actually introduced a national retail central bank digital currency in the world. I wanted to talk about the genesis in terms of why this was introduced in the Bahamas and what is unique about the Bahamas. As many persons may know, but not everyone, Bahamas obviously is an archipelago, which is a country with several islands. And we have the main islands in which most individuals will travel to from the world. And most of the commercial transactions are conducted. And that's on New Providence, or where Nassau is located. And that represents about 75% of the population. But outside of New Providence, there are a number of smaller islands and keys. Bahamas have actually about 700 islands and keys spread across a vast ocean mass. Probably about 30 to 35 of those islands or keys are inhabited. And what we find happening in most of these outer islands, there have been a situation where persons became unbanked because commercial banks were moving away because it was not viable for them to remain in these locations. And there was an issue in terms of financial exclusion that followed that unbanking of several persons in the outer keys or in the family islands, as we refer to it. That led to the genesis or the creation of the digitalized currency of the Bahamian dollar, which we refer to as the sand dollar. We also found that coming out of this unbankedness or lack of full inclusion within the Bahamas, about 18% of the adult population was unbanked. And banks were closing because of high business costs, as I indicated before. And they were associated with the dispersion of islands and repercussions of de-risking phenomena across the archipelago. So this was developed several years ago. Just some background information how it is doing. We have currently over just under $1.1 million in Bahamian dollars that is represented in sand dollar or central bank digitalized currency in circulation. That represents just under 0.2% in terms of money supply in circulation within the Bahamas. Other information, we have over just under 100,000 wallets in circulation in terms of customer circulation or customer usage, and spread across about 1,400 merchants. I don't want to, because all of this information will be included in slides, which will be shared with individuals, as well as the paper that will be forthcoming towards the month of June, or the latter part of, or the early part of July. But one of the things we looked at as well was we wanted to see what was the impact on the economy if there was increased circulation of centralized digitalized currency or the sand dollar within the economy, the impact it would have on consumption of money, the impact it would have on the economy in terms of overall consumption, productivity impact, as well as wages and so forth. So we did some analysis on our model within the Bahamas, because we have been going through this for some time using some sort of a generalized equilibrium model, using a neo-Keynesian framework. And it was a closed economy because, unfortunately, at this point in time, we're not using the sand dollar or the centralized digitalized currency in order to settle international transactions in terms of imports and exports. It is just primarily a local-based country commodity. And what we found is that when there was a shock or an input or significant input of digitalized currency within the economy, there was an increase in demand deposits by persons within the banking system. So they were actually putting persons within the banking system. So that started to solve some of the issues that we had before in terms of financial exclusion. And we're able to model this actually. There was obviously an increase in the number of persons who are utilizing the digitalized currency. And there was a slight fall off in obviously the usage of cash within the economy. The usage of cash obviously has its benefits, but it also has some disadvantages as well, which can be associated with some nefarious activities if it is used in large quantities across the wrong sectors and across the wrong industries. What we also saw in terms of our analysis is that productivity levels were able to increase, become more resources were in the financial system, which could now be filtered towards different players in terms of capital requirements. This resulted in a small uptick in terms of productivity levels on the supply side of the growth equation. And then we also saw improvement in wage levels that were modeled as well in some of these family islands, as well as output in terms of labor output. All of this, as I said, we can discuss more as we look at probably the slides or the paper that will be forthcoming. But long and short is that Sand Dollar has been a tremendous success for the Bahamas. It is uniquely suited in terms of our geographic profile or spread in terms of the archipelagic profile of the island. It has a robust infrastructure, but there's still room for improvement. There's a positive correlation between the distribution of sand dollar and certain key economic factors or indicators within the economy. On the social side, it has increased the level of education in terms of financial education through its usage as well. And we also see improvements in terms of financial inclusion matrices throughout the economy. Those are the early lessons that we have seen so far from or rolling out or development of sand dollar within the Bahamas. There are some considerations that we need to take into consideration. The expansion of sand dollar as a currency, as a digital fiat currency in terms of settlement of overseas and transactions, obviously transactions relating to imports and exports. The inclusion of other players in terms of distribution of this in terms of wider persons within the banking sector, not only the commercial banks, but also credit unions, insurance companies, and security brokers, as well as PSP, payment service providers, as well as money transfer brokers as well. But in short, it has been a success for us, and we're starting to see the benefits both not only on the social side in terms of financial inclusion and expansion of educational levels and usage of the sand dollar, but also improvements in key economic indicators throughout the economy. I'll stop there and take any questions or pass on to the next presenter.
Thanks very much. So indeed, let's give the floor to the next presenter. And the next presenter is going to be Ananya, who will talk to us about China, actually. So Ananya is from the Atlantic Council, but she works on digital currencies and in particular on how it's done in China. So Ananya, maybe you can tell us a bit more at which stage China is at the moment, what's the latest progress that they have made, and maybe explain us also their motivation for doing so. Thanks.
Thank you, and thank you for having me here today. I'm really excited to talk about other kinds of digital currencies and country experiences. And like you said, unlike Alan and Kwame, I'm not actually a central bank employee. I'm someone who studies and researches digital currencies in China as a part of my research. But I want to start with situating ACNY and what is a larger payments infrastructure in China. China has actually been very successful in creating indigenous payments infrastructures, and it started about 20 years ago with what is UnionPay today, which is a debit and credit card network. It's about the world's third largest debit card network, and it's meant to compete with the Visa and MasterCards of the world. 10 years later, we see the surge in mobile money wallets in China through Alipay, Tencent Pay, and they really revolutionized the way that Chinese people actually conduct transactions in their own economy, but also changed the way that we think about how people conduct peer-to-peer payments, can conduct peer-to-peer payments using their mobile wallets. So Alipay and Tencent Pay are really important in China's economy. They cover about 90% of China and are the world's largest mobile money market. Then we come to about 10 years later in 2015. We've already talked about CIPS a little bit, which is the cross-border interbank payments settlement system. And China starts developing this as a response to really sanctions on Russia and other countries when it realizes there's a need to think about alternatives outside of settling on the dollar. So what CIPS does is it's a messaging system and a settlement system that works with the yuan instead of the dollar. And this is really meant to compete with our correspondent banking network, the dollar-based infrastructure that Josh and Maria talked about earlier today. But it's also meant to compete with SWIFT, which handles messaging systems for a lot of the world. So really, this is where the ECNY, this is the context with which ECNY rises in China, which is about 2017. And it's meant to be both a retail and a wholesale payments infrastructure. What that means is that if I want a cup of coffee, I could use ECNY, but the way that banks would settle infrastructure, the way that banks would settle money between each other would also be using this broader infrastructure. So ECNY is a digital form of China's fiat currency, which is the yuan or the renminbi. The project starts in late 2016, 2017, and they do what is the research and advanced development in about 2 years, and really start seeing pilots coming out in 2019 for the first time. And these pilots cover the sort of bigger commercial regions of China. So you're thinking about the Yangtze River Delta, the Pearl River Delta, Beijing, Shanghai, Hebei, the big industrial centers where people are used to using mobile money and are digitally native in a lot of ways. In 2022, there's a big event that catalyzes a lot of the discussion that we have today about ECNY, which is the Beijing Olympics, where the ECNY gets rolled out really in front of the world. Foreigners can use ECNY, and we start getting data on how many people are using it and what they're using it for. So the pilot currently exists in about 25 cities in China. It includes a lot of smaller cities as well, where they're used for rural revitalization programs. There's about 250 million people, or 260 million people, who have access to ECNY in some form. But what we found through our research is that the amount that people hold in their ECNY accounts is actually very low. And I should say this at this point, unlike a lot of digital currencies, the ECNY is intermediated through the commercial banks, but you can also download a People's Bank of China wallet to access your ECNY. You can also use Alipay and WePay, again, two very popular forms of payments, to use your ECNY. So what we found actually was that people held very little amounts in their ECNY, which meant that they weren't really using it for a lot of purposes, really, and adoption has been low. To date, we've seen numbers come out, and it says that there's about 100 billion renminbi in settlement that's happened in ECNY. That sounds like a huge number, but that's about a third of settlement that happens using Alipay every day. So ECNY since 2019 has done about a third of Alipay's daily settlement amount, which really raises concerns about adoption and whether it's useful. But China's a very specific case where digital wallets are very common, and people have seen other kinds of use cases on digital wallets. So I think when you think about adoption, I don't think ECNY has been that successful. What I argue through a couple of the pieces I've written over this year and last year, that I don't even think adoption is the goal of these domestic pilots. I actually think that testing out different use cases, and China's testing about 200 different kinds of use cases, is the actual goal of the domestic pilots. And I'm happy to go into more detail about this in the second portion. But then we talk about what is the wholesale cross-border infrastructure of ECNY. So ECNY retail lets me buy a coffee. ECNY cross-border is how I'm going to use the infrastructure outside of China to settle in yuan or renminbi. And we've mentioned Project Enbridge before. We saw the latest results come out in October 2022, which were the first of its kind actual settlement that happened across 4 jurisdictions: China, Hong Kong, Thailand, and UAE. What we found was that almost half of those transactions happened using ECNY because the ECNY architecture is already well developed versus the other currencies. There's about 164 transactions happened between 20 central banks. And what changed is that instead of connecting through the dollar, connecting to a dollar settlement hub, these banks could directly connect to each other and conduct transactions with each other. So that is why it's impactful to have these cross-border wholesale tests, because you can actually test out, oh, how is it that I can move out of, maybe a dollar dominant structure of financial transactions. This obviously has raised a lot of concerns around de-dollarization or internationalization of the yuan. I'm very skeptical of these claims because I think that the capital controls that yuan has are going to translate to ECNY regardless of the form it takes, digital or virtual. So I'm skeptical of those of those concerns. I am, however, really interested in the internationalization of technology of CCNY. What happens when banks test cross-border central bank digital currencies is that they have to work through a lot of different regulatory and technical considerations with each other. And what you can see is a replication of China's technology and a replication of China's regulatory framework around the world when it comes to settling between currencies. So that's where I'll stop, but I'm really interested in talking about it more.
Thanks so much. That's very interesting. Let's go directly to the next speaker. So the next speaker is Jennifer Lassiter. Who will talk to us about the US. Josh already talked a lot about the US, but we can go into more details about what's the stage of the discussion in the US. In particular, at some point, he mentioned that it became very political. If you can tell us more about that, that would be very interesting.
Absolutely. And thank you for having me here today. I am always humbled to take the stage to talk about CBDC with central bankers. Great to see some familiar faces. And I'm positive every time I hear Ananya Kumar speak, I learn something new. So this is a great company to keep. I'm Jennifer Lassiter. I'm the executive director for the Digital Dollar Project. We are a nonprofit based outside of Washington, D.C., focused on encouraging and executing private sector experimentation on the research of a U.S. central bank digital currency. So Josh did steal some of my talking points earlier. I am going to dive a little bit deeper into some of the references that he made and hopefully provide some counterpoints or at least some temperament to the statement that the U.S. is not moving fast enough through exploration of CBDC. I would argue that we're moving not as quickly as other regions, but certainly in a more accelerated manner over the last 18 months. So as I'm talking through the activity, and Gregory, you alluded to this as well, in the United States, I will say there are kind of 4 categories you can think about in terms of CBDC discussion or CBDC decision making. The first will be the executive branch, the second, the legislative branch, the third, the Federal Reserve Board and system more broadly, and then the fourth bucket, which I like to call experimentation, where I will overview what's happening both within the Federal Reserve and within the private sector. So starting with January of last year, as many folks in this room may be familiar, the Federal Reserve Board released a discussion paper, Money and Payments, the US Dollar in the Age of Digital Transformation. This paper examined the pros and cons of a potential US CBDC and was the first step in a discussion, I would say at least of public nature from the Federal Reserve Board of whether and how a CBDC could improve the safe and efficient domestic payment system. Immediately following that, in February of last year, the Federal Reserve Bank of Boston, in partnership with MIT's Digital Currency Initiative, released Project Hamilton Phase 1. To date, this is the first and only U.S. research on retail application of central bank digital currency. This research started in 2020 and it had 2 goals. First was to design a core transaction processor that meets the robust speed, throughput, and fault tolerance requirements of a large retail payment system. And 2, to create a flexible platform for collaboration, data gathering, comparison with multiple architectures, and other future research. What I love about this project, beyond the fact that it was retail application of CBDC, is that the code was not meant to be put into production. The Federal Reserve Bank of Boston was very clear about this, but rather released to provide the start for a broader exploration and to encourage this behavior. The work was shared under the MIT open source license, and anyone in this room and beyond can engage in that code and that work if you go to GitHub and search for Open CBDC. So immediately following the release of those results in March of last year, President Biden issued an executive order on ensuring responsible development of digital assets. So just a quick note on what an executive order is in the United States. An executive order is a signed, written, and published directive from the President of the United States that manages operations of the federal government. And I like to call that out because even within the United States, the executive order was highly politicized and I think misrepresented in terms of what it was directing agencies to do. So this particular executive order calls for several measures. Often we hear the 5 principles that were anchoring the U.S. exploration of the business case for CBDC in. This is where you'll hear conversation around financial inclusion, security, interoperability, competition and innovation, and the like. But this executive order specifically instructed U.S. federal agencies to dedicate resources to support technological advances and ensure responsible development and use of digital assets and to explore a U.S. central bank digital currency. Following that executive order, which again was released in March of last year, June through October, we saw the agencies outlined in the executive order releasing requests for public comments and a total of 9 working papers released. The most significant of which, of course, I would note comes from the Treasury Department, but my highly recommended reading and the report I enjoyed the most was from the Office of Science and Technology Policy. Their paper was an analysis of the technical possibilities of a U.S. CBDC and was fantastic, in my humble opinion. So across 2022 and 2023, there have been multiple attempts at legislating CBDC research. To be very clear, none have been brought to vote, let alone pass through both chambers of Congress. And as Gregory noted earlier, there has been a bit of buzz around some political rhetoric involving central bank digital currency in the United States, but we have yet to see if that actually moves on to the presidential platforms next year once we have 2 candidates for presidential office. So in early November last year, the Federal Reserve Bank of New York launched Project Cedar. Briefly, this is a multi-phase technical research effort that evaluated the potential applications of financial technology solutions to improve the efficiency of wholesale cross-border systems. In mid-November 2022, Digital Dollar Project and the Depository Trust and Clearing Corporation shared findings also from a wholesale CBDC security settlement pilot, which focused on improving efficiencies in post-trade settlement of tokenized securities with a tokenized U.S. central bank digital currency. This pilot included participation from Bank of America, Citi, Nomura, Northern Trust, State Street, Virtue Financial, Wells Fargo, and a few others. And then in late November of last year, the Regulated Liabilities Network US pilot was announced and the white paper was released outlining a 12-week proof of concept project exploring the feasibility of an interoperable network of digital central bank liabilities and CBDC utilizing distributed ledger technology to connect deposits held at regulated financial institutions. So that's all of last year, which is a lot of activity in 12 months. For this year, just briefly, and then I'll call out a couple patterns in some of the design choices that were made in these experiments and next steps. In January, Digital Dollar Project released a second white paper setting up the business case for U.S. central bank digital currency experimentation. And in February, the Digital Dollar Project launched an initiative focused on defining, designing, and measuring efficacy of privacy options and requirements for CBDC. In April of 2023, the RLN UK pilot findings, analysis, and next steps were released via a white paper through EY. And in May of 2023, of course, as we've already referenced, Project Cedar Phase 2 and Ubin Plus was released through the Federal Reserve Bank of New York's Innovation Center in partnership with the Monetary Authority of Singapore. So, in summary, back to the original question that was asked, which is what we've learned and what is next. I would say 3 areas of focus in the US that I would call out. One is a prioritized focus on wholesale application of central bank digital currencies to meet the objective of improving cross-border payments. 2, a focus on creating global connected networks, and 3, ensuring financial stability in a rapidly digitizing and tokenizing global financial environment. The patterns that we've seen in the technical design choices through all the experiments that I just described include tokenization, which is a digital representation of the liability, whether it's a CBDC, a bank deposit, etc. Multi-asset, so the pilots are looking to support exchange and settlement of multiple types of assets, including different types of currencies and asset classes, and looking at how CBDC can facilitate and enhance those transactions. Programmability, so the use of smart contracts to automate actions and support 24/7 settlement, again, particularly relevant for our wholesale settlement pilots. Global networks, any innovation should support domestic and international use cases, and based on distributed ledger technologies. So really leveraging a shared ledger to provide a powerful, efficient, and secure settlement system. And then finally, I'll just call out broad next steps, I believe, in the US include exploring privacy preserving options and global standard setting, which we will talk about more, I'm sure. And then specifically exploring the following 3 questions. A need for legal analysis and global policy frameworks. So this is particularly important for transactions crossing 2 or more legal jurisdictions, of course. Defining governance, onboarding, and oversight. So ease of user experience, how to share onboarding and compliance risks and costs amongst intermediaries. And then finally, a question that came up in the previous session, who pays for it? So the cost to develop a new network and integrate to existing infrastructures is expensive. Who pays for the modernization of a financial market infrastructure? If this is a public good, as Josh described, driven by CBDC development, should this be accomplished through public-private investment? And through public-private investment, could we also establish trust and potentially support and help with adoption? So in closing, thank you for the time. I'll reiterate that the US has made no decision around deployment of a CBDC while we are in the research phase. There is a lot of extensive, sometimes or often divisive and varied levels of education around the business case and the need for the various applications of central bank digital currency. And I'm very excited to learn from the hard work that's being done outside of the US already.
Thanks very much, Jennifer. So, as I was saying, last but not least, Katarina. Katarina, can you tell us a bit more than what Maria explained already about what's the thinking, the current thinking at the ECB, and maybe what are the next steps?
Actually, Maria already mentioned a lot of the points, and especially the motivations that the ECB puts forward towards issuing or going forward with the Digital Euro project. I would just like to stress first that the ECB is mainly thinking about the retail CBDC with this Digital Euro project. It is now in the investigation phase and already released 3 progress reports in which it gives us a bit of a flavor about how the ECB is currently thinking about designing this Digital Euro. So the discussions on the wholesale CBDC are quite mute. Late in April this year, actually the ECB came forward with a press release that it will start looking into this, but it's something very recent, and the focus right now has been mainly on the digital CBDC. And actually just summarizing a few points that Maria mentioned in the previous session on the motivation. So the ECB has put forward this argument of the monetary anchor that it was very well discussed. So protecting the role of the public money in providing this monetary anchor for the financial system, as we see cash usage decreasing and also somewhat an increase in the use of cryptos. But, more generally, just a digitalization of payments, especially during the pandemic, we saw that a lot of people starting buying things online. And so there's this general trend moving towards digital and less physical cash. And so this is one of the main core arguments that the ECB puts forward looking into this. And then actually the question that was asked here in the audience about, the euro area payment landscape being so fragmented. So this is actually something that the ECB is also trying to address, and he claims that, a digital euro would really be a form of unifying the payment landscape, and somewhat allow for, even though the infrastructure is already in place, because for instant payments we have the payment infrastructure in place, which is the TIPS, that is actually run by the ECB. The problem here is with the payment services. There's no unique payment service that allows for digital payments to happen across the euro area, and this is certainly an issue that the ECB thinks the digital euro could solve. Another aspect has to do with the strategic autonomy to a certain extent, so reducing external dependencies and somewhat increasing the resilience of the European payments. And this has to do with the statistic of the 70%, so that 70% of European card payment transactions are currently being intermediated by foreign players. I mean, if we all grab our cards from our wallets, it's probably going to be Visa or MasterCard, right? And this justifies this very high number. And what the ECB would like to do is have this unique European solution that would not only help with resilience to the extent that we will be less dependent on the outside in case there are disruptions, some geopolitical tensions, etc. But also, somewhat also reducing the dominance of these very few payment service providers that currently clearly dominate the payment landscape everywhere. Then there are other minor arguments that are also put forward, but I mean, for instance, that a digital euro could be expected to then provide kind of a starting point for more innovation, because then banks and the intermediaries would be able to, build up on this digital euro and offer innovative services on top of this. But also the point of financial inclusion, for instance, as cash, for instance, is not accepted in e-commerce, and so this would help people become included somewhat digitally. It's important to also notice, and this was very much reinforced in the previous session, that the ECB acknowledges the importance of being ready. So regardless of the decision right now of issuing a digital euro, it's important to be ready to understand the works, the technology, and in case in the future this goes forward, then be ready to launch the digital euro. In terms of key design features, which is something that was not so much addressed in the previous session, so something a bit more new, so I would mention just the main points. Of course, as you imagine, it's 3 progress reports. There are many points that have been covered, but the main ones that really define the key features of this digital euro, as the ECB sees it, of course, is that, first of all, this digital euro should aim to replicate as close as possible cash features. For instance, not being programmable. Right now, we can go anywhere, you use our cash and pay, and the ECB has no idea how we use this for. In the case of the digital euro, this will be the case, and the ECB has reinforced that digital euro will not be programmable money, meaning that, I don't know, for instance, it will not prohibit us from buying an alcoholic drink with a digital euro. This is what it means. Then also the issue of anonymity. So cash is fully anonymous, but digital euro wouldn't, in principle, be fully anonymous, because there's some level of information that needs to be given, especially for higher level payments, in which some money laundering checks, financing terrorism, I mean, these kind of checks need to be there to avoid, misuse of this money. But the ECB has mentioned this tiered approach, so for very low value payments, it would be possible to keep it anonymous, and also proximity would function in this system. There's a bit of details about this. And something that is also another crucial point is the fact that the digital euro is meant as a means of payment and not a form of investment. This is very much mentioned, and this would be actually ensured by the holding limits. So I think everyone here has probably heard about these limits that Executive Board member Fabio Panetta has put forward, between the 3,000 and 4,000 euros. That would be the maximum holding that an individual will be able to have in their digital euro account. And this would also avoid major disruptions to the current financial system as we know it, and particularly the excessive withdrawal of deposits from commercial banks. Then just another few points. So the digital euro would be issued and settled by the ECB, but should in principle be distributed by so-called supervised intermediaries. These are banks and other payment service providers, and they would take care both of these, for instance, the money laundering checks and all the onboarding with the end user. So with each one of us, actually, we should be able, through our current payment service provider, our bank app, to be able to open an account in digital euros. And last, the target users are primarily euro area residents, but it's the ECB has already mentioned that it could open up to others. Just in terms of next steps, so the ECB has already issued these 3 progress reports. We are finishing now, the ECB is finishing the investigation phase, and by October 2023, we actually take a decision on whether to progress to the next phase, so the preparation phase. And it's important to mention that this does not mean that it's a decision on issuance, that we will issue digital euros. No. Actually, the issuance of digital euros will first have to rely on a legislative proposal that will set up the grounds for the digital euro to be able to be established. And actually, by the end of this month, it's expected that the European Commission launches the initial proposal of this legislation, and let's see how it goes. But it's probably important to stress here that, you know, if the legislative proposal or the regulation in the end does not come up, this means that the digital euro cannot be issued. However, if this goes forward, the ECB still has a say in which it can decide whether to go ahead and issue the digital euro or not. So there's here these 2 steps. And I think I stop here.
Thanks very much, Katarina, and thanks all the panelists for their introductory remarks. I wanted to start actually with my own little poll. I don't have a poll organized on Slido, but I wanted to have a poll with the different speakers. And actually, I would like to ask a very, very basic question, so please answer only with 2 words. Is what, in your view, in your own jurisdiction, what would be the value added? Because we heard many motivation, financial inclusion, being a monetary anchor if cash disappears, the fear of displacement by either private or foreign currencies, geopolitics was also highly mentioned. But I guess all those different motivation plays a different role in different jurisdictions. So if you had to tell me just one for your jurisdiction, what would it be? Let's start in reverse order. Katarina, what do you think would be the biggest value added for the creation of CBDC in the euro area?
Actually, what we argue in our paper is that currently, these arguments are not enough for a retail digital euro to really add value at this point. Of course, in the future, this could change. I would say that maybe a very important point is this fact of the current payment system being very much intermediated by foreign players. Of course, I mean, regardless of what will happen in the future, it's important to ensure a European solution to a certain extent.
Geopolitics and strategic autonomy is your answer, right?
I would say more European resilience.
Okay, nice. Jennifer, what do you think would be the US reason to have a US CBDC? The main reason, in really 2 words?
Future-proofing, building new infrastructure.
Okay, that's a nice
2
one,
words, right?
It encompasses everything, basically. So that's a great answer. Ananya, for China, because you play the role of the Chinese expert here.
Sure. I'll actually one-up you and say 1 word. I actually think of programmability as a positive function of CBDCs everywhere.
Okay. Even though we didn't discuss that at all until now, so we can dig into that later. Alan, what do you think? You mentioned several times financial inclusion, but I don't want to
that obviously is my answer, and those are the 2 words: financial inclusion for us.
Okay, good. And Kwame, finally.
Same thing, financial
Financial
inclusion.
inclusion. Okay, no, that's a very interesting result. So we see that different countries have really different reasons to launch this and to work on this. That's great to hear. So again, I wanted to ask you a question because more than one of you, actually, I think three of you, mentions that CBDC, and in particular retail CBDC, would take place through intermediaries. So I think, Kwame, you mentioned that when it will be launched, it will go through intermediaries. Ananya, you said that it's mainly going through intermediaries. Katarina, I don't think you mentioned it, but I heard that the ECB wants to do it through intermediaries. So Alan, I don't think you mentioned that, but I would like to hear how it's done in the Bahamas. But first, my main remark is, doesn't it defeat the purpose to use intermediaries? Because in the end, what's good about cash is that there is zero intermediaries, and I can go to cash if I don't trust intermediaries anymore. Actually, that's what we see during banking crisis. You have run from intermediaries. There, if in the end my digital euros, even if they are like liabilities of central bank or whatever, they will still be parked through intermediaries. And therefore, if I don't trust that intermediary, it might defeat the purpose, because I'm not sure that actually citizens will really see the difference between the bank account, the normal traditional bank account where there is commercial bank money, and the other account where it's public digital money. I'm not sure the difference is so obvious. What do you think about that? And what do you think about the fact that the intermediary seem to play a very important role in every jurisdiction? And maybe let me start with Alan, because I want to know how it's going in the Bahamas. Do you use intermediaries?
Well, we do, and it's a hybrid system because we have different tiers in terms of the sand dollar, or the central bank digital currency that we have here. I indicated it in my opening talk. We have almost 1,400 or just over 1,400 persons or merchants who are operating or helping us in terms of the whole process of engaging with the public, or what you refer to as payment service providers or intermediates. But we have a total of over just under 100,000 persons who are actually using these wallets, these digitalized wallets. Many are not going through payment service providers, or those 1,400. So at the lower level, where the value on the wallet is under 500 Bahamian dollars, which is pegged to the US dollar 1 for 1, or the equivalent, as I said, in 500 US dollar. Most of those persons are not going through intermediaries. Individuals who are engaging or using sand dollar for business transactions, receiving payments and making payments on goods and services, normally at the upper level of anywhere about $10,000 or more a month in terms of transaction levels, they are using intermediaries. So the vast majority of the transaction, or the sand dollars that are in circulation now, are going through non-intermediaries without those 1,400 individuals. So that kind of cushions us from some of the points that you were indicating in terms of adverse effect upon the banking system. If there's a run and you have the movement of this M1 commodity in the hands of a few individuals or intermediaries. And then also we find that for those persons who are at the low end in terms of usage of the sand dollar, their know your customer requirements are obviously much less stringent. They have to provide us basic information, name, maybe an address, a telephone number, and that's it. They don't have to go through the strict KYC requirements of individuals at upper level of $10,000, $15,000, or even $20,000 usage a month, which are these individuals that are running through most of the merchants or the payment service providers. So it's a diverse system, it's a hybrid system, and it's one that we have to use because in terms of the profile, and I mentioned this in my presentation, the profile of the island or the economy, where you have vast number of persons who are outside of the major economic or commercial activities or commercial port of New Providence, and Nassau. And you have persons who are living in these family islands or these outer islands. They are not, in all cases, able to access payment service providers in these locations. So their access through the digitalized wallet or the sand dollar has to be on a direct basis with the system that we operate here from the central bank, without going through one of those 1,440 payment service providers within the economy.
Maybe I would like to hear also your reaction about that, in particular because you mentioned financial inclusion as one of the most important reasons to introduce a CBDC in Ghana. What kind of intermediary are you going to use? Because in the end, if you use only commercial bank, you don't solve the problem, because most of the people who you want to target are people who actually are unbanked. So what kind of intermediaries are you thinking about?
Okay. Well, thank you very much. So two things I had to, I think, take a step back and reset everyone's mind. Remember, it is not a bad thing if people actually experience the use of CBDC and the user experience is similar to either mobile money, a basic digital payment app, or anything. It's actually good. Remember, there's a lot that is happening, but this whole, as Jennifer put it, the future-proofing of this whole payments and currency space is really the equivalent of switching from combustion engines to electric motors. It's still a steering wheel, it's still foot pedals, and perhaps a gear knob somewhere. And so consumers should not have to jump a very high curve in order to be, or high bar, to be able to use CBDC, because uptake is very critical to the success of CBDC, irrespective of how beautiful it is. This is where the CBDC development goes into product development a bit, and we have to be very careful about that. The second thing is that this is technology, and obviously the central bank is absolutely able potentially to start directly engaging with consumers at a retail level. The problem is, what is the sustainability of that, and how viable would that be? And so in our environment, at least what our thoughts are, is that the commercial banks are already, per the existing two-tier model, the ones at the wholesale level distributing physical notes and coins. So they play one role at that level. And then at the retail and innovation level, they're providing different services. Today, they are not doing that alone. There are various payment service providers and non-bank financial institutions in that space as well, who are now going to be able to be empowered, including fintechs, to deliver some of these services to consumers. And even at that level, we also have to, again, look at the issue of custody. So you could have self-custody after having access CBDC from a bank. And that self-custody means, perhaps in the case of offline that we tested, people had it on their own smart cards. And it's with me, and I can use it whether the bank is working or not. So that's one. If I'm accessing it through a fintech provided solution or something of that nature, that's a different context as well, depending on the nature of the relationship or the service being provided. I think this is where you highlight the risk that it begins to feel like commercial bank money. And of course, I think consumers might struggle to distinguish that. But as it stands right now, let us not forget, using a basic payment app versus mobile money, and sometimes even using some of these crypto payment apps, feels no different, right? Experientially. But on the back end, there are different reasons and incentives why people use them. So I think it is not mutually exclusive. It is entirely possible to have this mix, and that is actually supposed to be, and for us, that is actually the motivation for why we're getting the commercial space involved and private sector actors, so that these options can be created for various consumers. And should the need arise, they have the necessary options available to them. They are empowered to be able to utilize CBDC in a way that best fits their needs. So that's just my thoughts around this whole approach. And it really helps drive the conversation about financial inclusion, because you have not prohibited access or restricted access, but at the same time, you've also created a path where people can go out of just basically getting access into perhaps enhanced service delivery access from the various players with whom they may have interacted at some point. And the data around them can be scored. They can be getting access to services such as insurance, savings, credit, etc. So that's sort of what a journey would look like. And I don't really see central banks fully implementing that leg of it. So it's a very strategic question that we have to answer for ourselves to be able in our design of our CBDC. And this is the design choice that Ghana has made. Thanks.
Thanks very much. Ananya or Jennifer or Katarina, do you want to react also on this question of the role of intermediaries for retail CBDCs?
Sure. What Kwame just said was perfect. Actually, there's not much I would add on top of that. That was very well explained, and I think is relevant also for the United States. I would add that in terms of defining intermediary in the United States is an opportunity as we're moving through this process, which is to say, can we expand who has access potentially to the Federal Reserve System, which might help potentially with that inclusion component when we think about intermediated distribution. I would also note, and I will touch on that, I will go a little bit deeper. Kwame referenced kind of product design principles when we're thinking about CBDC. Also referenced in his opening remarks was a conversation around consumer preferences and what is driving some of the design decisions. We don't need to build and release a perfect system that is evergreen. That will not work. It needs to be a system that is flexible and can be iterated on as technology develops. And those iterations are driven by consumer preferences and understanding people's relationship with money. And through that, what we see right now by using the intermediated system is optionality, so that you are able as an individual in a retail instance, of course, to be able to choose not only between commercial cash or public money, but perhaps also to help provide the business case and the value proposition for why public money should exist in a digital form and how it would be used. So again, I think really focusing on consumer-driven needs to help define some of those design objectives and building a system that can be flexible to change is really important. Ananya?
Did you want to add something, Ananya?
Not on intermediation. I think we've captured all of it.
Katarina, or I give the floor to the audience. Okay, Katarina, please go ahead.
No, I just wanted to add that actually in the progress reports, actually in the last one, the ECB mentioned that there could be the development of a Eurosystem app, and the consumers would have the choice to go through their normal banking app to access their digital euro account, or there would be this pan-European Eurosystem developed app. So the consumers would have the choice in terms of intermediation where they want to go through. There would be that option. And I remember Ananya actually mentioning that the People's Bank of China also provides a certain similar app in the introductory remarks.
I'm looking forward to that moment where the ECB will have to manage 400 million bank accounts for all Europeans. And it's going to be even more difficult for the Bank of China. So are there any, yes, so there are a lot of them and we don't have much time. So let's say the two gentlemen over there, the gentleman in the back, and then Maria. So 4 questions. Let's take the 4 questions together and then give back the floor to the speakers.
Hi, I'm Max from the European Association of Clearinghouses. I'm personally curious, do you think the ECB has done a good job in selling the concept of digital euro for retail purposes to the general public? And is there a disconnect there that should be addressed?
I'm Jimmy from Bold Partners Consultancy, and I was just wondering, I think, Katarina, you mentioned it once, but otherwise it hasn't been mentioned. Who will pay for it? Oh, wait, no, sorry, Jennifer, you mentioned it. Who will pay for it? I've heard 4 options of the taxpayer, merchants, financial institutions, or the ECB, which I guess is taxpayers as well. So, yeah. Does anyone have any ideas on that? I'd be most interested in the digital euro specifically. But.
Thank you. Antonio García del Riego, member of the European Economic and Social Committee and rapporteur on the opinion on digital euro. Thank you for the discussion. Very, very interesting. In my view, what the ECB is looking basically is for an excuse to launch it. And in my opinion, it makes all the sense to have a digital euro, mainly for strategic autonomy rational and reasons. Number one, if you think about how fragmented is the market in Europe, you realize that we need to have a main framework for the domestic solutions to work on. Number two, not only in the payment sector, but also in the more general banking activities. For instance, in the investment banking side in Europe, the market is dominated by 5 American banks. 60% of the market is dominated by 5 American banks. Now you add this 70% in the hands of 2 American companies in the payments sector. Again, the autonomy of the financial system in Europe can be improved. Let's put it in this way. And then those are my comments, and then my question to you. My question to you is the value of the data. The value of the data. The 70% of the European transactions is in the hands and in the knowledge of 2 American companies. When we think about innovation, I think that there is the point, and there is the base for financial innovation in Europe to make use of this incredible amount of data that are escaping us somehow. So my question to you, whether we should delve into innovation via data that is in the hands of, in the transactions that are taking place in Europe today. Thank you.
Thanks, Maria. Great questions, by the way.
Thank you very much. I won't ask a question on the digital euro. I wanted to ask the other panelists, particularly Anania, you mentioned the main motivation for China being programmability. Can you please elaborate on this? What do you mean by that? How is that a motivation? And can you elaborate what this means? And Kwame and Anal, I wanted to ask you, you've concentrated on telling us about the retail side. Can you briefly also comment on your thinking on the wholesale side, either wholesale domestic or wholesale across borders? Thank you.
Okay, so given that we don't have much time, we'll go directly, I will do a round and you can answer whatever question you prefer. How do we start? Let's start with Kwame, then Alan. We'll do the same order as the initial one. So Kwame.
Okay, oh, thank you very much. So I think I'll touch on 2 quick ones. On the issue of costs, how we've looked at it in Ghana is that this is a payment system modernization opportunity, and therefore the central bank has to bear some initial cost for it. But we're also thinking through the design process of building our infrastructure and our deployments in a way that, for instance, leverages bring your own device, right? So just because we're trying to introduce new smart cards that can be used offline does not mean now we're deploying a new set of POSs by the central bank itself. Can we instead give service providers their APIs and give them the software developer kit so they can integrate it into existing POSs, etc. That way we reduce the cost burden on us as a central bank. There will be some cost on the service provider layer, and that's why it's also important that there's somewhat of a commercial model around some of the product innovation that will be created to be able to account for the cost on the back end. And to the last question that Maria was asking about wholesale, in fact, I will say this, the wholesale business case for us was very straightforward. As it stands, because we don't have real-time RTGS and settlement, we actually have a challenge of pre-funding mobile money interoperability transactions. And for the largest player, on weekends, they have to pre-fund what is the equivalent of about $50 million in an environment where interest rate is about 20-something%. So that business case is very clear-cut for us. And one thing we did was to build a business case on CBDC and its introduction, and a case for domestic clearing and settlements using CBDC at a wholesale level was very strong for us. Thank you.
I was second, right, Chair?
Yes, go ahead.
Well,
Repeat your
initially the
question.
costs are borne by the central bank or the government here in the Bahamas, because obviously we see it as a public need in terms of the whole aspect of getting to wider sections of the population, and the population that needs to be included more in the financial system, either through the fact that they have been excluded or they were debanked in some way or another. Gradually, what has been happening as we include more commercial players, they are now bearing some of the costs in terms of the operation of the system, as it is being used by commercial banks in many of these outer islands or outer areas outside of the city, where almost 100% of the population is banked. They are now bearing some of the costs in terms of infrastructure costs in order to keep the system operational in many of these areas and compliant with their system that they may have. We have primarily Canadian banks here, with some US banks, and maybe a couple of local indigenous banks. And they have been migrating to the system to be used with their customers, as they try to garner more customers and to enhance the profile of the existing customers that they have. So it has been gradual. Started out as a central bank or by the government, and now gradually the private sector is now bearing some of the costs as we go to a more commercial use and a wider retail usage of the infrastructure that we currently have.
Thanks, Ananya. The question on programmability of CBDC.
Great.
This one was
Yeah,
especially for you.
Yes, and I'm very excited to talk about it. So I think I'll start with talking about why I think that programmability has become a bad word. I think we've tried to categorize programmability as something that offers constraints onto our system. So the example that we used earlier, which is that, oh, maybe programmable money will prevent us from buying whatever it is, wine or cigarettes, whatever our vices are. I actually think that is maybe a flawed way of thinking about it. I think programmability is the ability for us to use the backend technology of a CBDC in different ways to achieve some kinds of goals. And I think what we could actually achieve through programmability is transformational. I think what we could do with programmable features is the ability to maybe pay our utility bills on time and enable more kinds of liquidity provisions and reduce volatility. We could enable sort of PVP, delivery versus payment systems, in a better way so that people are able to sort of manage their money better than they do right now. So I don't think of programmability as a necessarily negative feature of central bank digital currencies. I think there's guardrails to be built around it. Now, when it comes to the case of China, and when I think about China, I talk about programmability specifically, is because when I look at the domestic pilots, there's about 200 different kinds of use cases being tested in China currently. They include credit provision, integrated ID cards. One of the use cases I like to talk about most often is a PBOC employee card that serves as your employee ID card. It serves as your trade union representative card. It serves as your offline sort of wallet that can enable you to buy lunch if you're a PBOC employee in your building. So I think that's an interesting feature of programmability that I don't think we talk about more often. And I think as central bank digital currency test cases become more complicated, as we start testing security settlement, as we start testing credit provision, we actually will see the benefits of programmability over time.
Thanks. Actually, this sounds quite frightening that all this data is pulled together in one card. No? So Jennifer, the question I would like to ask you is that, yes, some people mention like those two US giants. Nobody mentions their name, but I guess everybody's talking about Visa and MasterCard. What's the risk for them also? Are they going to run out of a business model? And what's the risk for the US?
Yes, I guess is how I would respond to that. That is a plausible risk, right? If you were going through a wargaming process, that could be one scenario that you try to look at, which is impact to strategy and operations, not just specific to Visa and MasterCard, though I know those were called out specifically in this conversation and have been more broadly in media comments coming particularly out of the ECB. But I do think that understanding how strategy and operations can be impacted by digital assets broadly, including central bank digital currency, and how a company needs to transform to meet those future needs is very critical. And I would highlight the work that SWIFT is doing right now is a really great example of a company that has provided a very specific mandate for decades upon decades now, and their exploration and how they can really work as the network connector in a fully digital future, and whether that's connecting tokenized central bank digital currency or tokenized bank deposits or real-time payment systems is irrelevant. It's connecting all of those pieces. So I would encourage all companies to do exploration, and all countries to do exploration to really understand what is technically feasible, which is often more than we're ready for, and how that lines up with the policy objectives of each respective economy. So it's just been very encouraging to hear all of these conversations. I will also just add, we didn't talk about privacy a lot in this conversation. I think in the context of the United States, privacy is the deal maker, and our ability to be able to not only prove kind of degrees of anonymity, privacy, and confidentiality, because again, privacy can often be from whom, when, and how. You can build a central bank digital currency, or at least we're experimenting on doing so, where you have varying degrees of privacy throughout the technical layers, but being able to explain that in very plain English to consumers and broadly is critical in terms of whether or not, even if deployment happened in the US, if there would be adoption. And as data was invoked in that last comment, I think data privacy, self-custody, there's so much for us still to explore and understand there that I think, along with Ananya, can be an enhancement to the existing service, and I think very positively about, and just encourage people not to be afraid of it and back away from experimentation, because it is so critical.
Thanks, and thanks for pointing out that there are not only risks but also opportunities. So creative destruction at its best. Katarina, last words?
Yeah.
Because I realize it's already 50.
Okay, yeah, now it's actually linking all these last parts on programmability and data and privacy as well. Actually, the ECB has mentioned very clearly that the digital euro will not be programmable, but it addressed conditional payments, which is exactly what you were mentioning, Ananya, on doing these regular payments, but they call it a different thing actually. Yeah, of course, you just commented, oh, that's a lot of data and a lot of things that can be done. It's true, and right now, indeed, it's these US providers that have access to all this data. While it is true that this is a lot of data, there's also a lot going on the data side in terms of regulation, in terms of imposing rules on how this data can be used. And one thing that the ECB really stressed, because it's one of the main concerns of European citizens, there were various studies and they all feature privacy as one of the main concerns really. So the ECB is really trying to work, and they mentioned this a lot, on ensuring the highest standards of privacy. And they mentioned that so the ECB as a public entity will not have access or use this data. Somehow it would be the intermediaries that do this onboarding and connecting with the users that would somehow have access to this, but under very strict rules. Then just very quickly, also regarding this thing of privacy, one of the questions was about the communication of the ECB to the citizens. And privacy is especially one of these things that needs to be further explained. Actually, in our paper that we just released, one of the things we understood, and Maria also mentioned this in the first session, is that sometimes there's this confusion, especially in countries that already have CBDCs, about the difference between a CBDC and cryptocurrencies, because they see all this as very digital. So indeed, that's something that the ECB really has to think about carefully, how to motivate this also to bring people to use the digital euro and have successful take-up if it is launched, of course. And last but not least, the way I understood your question is that you were asking about the compensation model, right? And this for, yes, indeed. So in terms of compensation, the ECB has been very careful in setting the digital euro in a way that resembles very closely what already is in place while having a benefit to the user. So a digital euro would be free for the user. Merchants should have fees that are not higher than what they already have, even though the ECB believes that the infrastructure of the digital euro would allow for lower fees because it would be very efficient. Then in terms of the intermediaries, indeed for them to have the incentive to do this intermediation and provide a digital euro account, the ECB has mentioned that it's important that they have the right compensation, at least, basic fees for the costs that they incur. And last but not least, the ECB would support the costs of the issuance settlement of the digital euro on its own, because it would indeed be in charge of those functions, while the whole intermediation and distribution would very much abide by the current rules, if not cheaper. That's the objective. Yeah, and I think I stop here. I think I answered all questions.
Thanks very much, Katarina. No, actually, we are already above our time limit by 10 minutes, so I really apologize to our audience about that. But I really want to thank our speakers who really all brought different perspectives and very good points. I hope we'll have the chance to discuss again and to dig deeper into some aspects, privacy, programmability. Also, something that we didn't discuss is potential side effects of CBDC. So it's just the start of the conversation, and I hope we'll have the opportunity to continue this conversation. So thank you very much. Thanks the audience, thanks the speakers, and see you next time. Bye-bye.
Yeah.